Welcome to the balance sheet, where you rise above the noise and learn about the most important business issues of our age. I'm your host and fellow student, Conrad Chua. We're living in a world where there's more and more data available, and it can feel difficult to separate the noise from signal, especially when it comes to thinking about investment returns. Today's guest has made it a mission to help people take a longer view of this. Professor Elroy Dimson is finance faculty here at Cambridge Church Business School and chair of the Center for Endowment Asset Management. For the last 25 years, he's co-authored the Global Investment Returns Yearbook. So welcome, Elroy.
Well, thank you for inviting me. This is a new experience for me, so while I hope everybody learns from this, I hope I learn something as well. It's a great pleasure to share the work that I've done with my two colleagues and co-authors, Paul Marsh and Mike Staunton, who are at London Business School. That used to be my home till 15 years ago when I migrated to Cambridge.
Elroy, can you start by telling us what is the UBS Global Investment Returns Yearbook?
That's exactly what I was about to do. 25 years ago, we wrote a book with myself, Paul Marsh, and Mike Staunton on long-term investment returns. We collected data for a large number of countries, and at the start of the new millennium, we published a book which contained long-term investment returns from stocks and bonds and so forth for 10 countries for 100 years. It was a millennium. It kind of fitted in with that title. And that shortly afterwards was published by Princeton University Press in an expanded version called Triumph of the Optimists. And we thought we'd answered some questions that people might pose, but it turned out there were more and more and more questions. And so we wrote a yearbook and another yearbook and another yearbook. And so now we have a new book, nearly 300 pages long, and there'll be another one, we hope, the year after. It's supported by UBS, formerly by Credit Suisse.
Great. So, Elroy, you've got a couple of slides you wanted to show us.
I do indeed. Let me have a look at the slides with you. First of all, just to make my hat tip again to Paul Marsh and Mike Staunton, and also to UBS, who have taken over support as they acquired Credit Suisse. And so it's a very good relationship that we have. And what I wanted to do is tell you a bit about our data set and what sort of questions we can put to it and what sort of answers it provides. So let me give you a very brief overview. I'll tell you something about the content of the current yearbook, and I'll touch on other years. I'll tell you something about its coverage, and I'll summarize the historical returns on stocks, government bonds, treasury bills, and other important factors such as inflation. Then what I want to do is to select some findings which I think will be compelling for those of you who are interested in investment themes. And finally, each year we have a special feature article, a particular chapter of the yearbook. And I'll briefly touch on that, and I'll give you a link so that if you want to do more reading on a more focused topic, you can do that. So let's have a look at this. This is the new book. It's very recently published, and we're getting quite a lot of media exposure from this as well. I'll show you a little bit of that later on. What does this book look like? Well, first of all, it provides you with evidence on long-run returns from the major asset categories. It provides estimates of risk and risk premiums that reward for exposure to risk and projected returns. And we look also at historical style returns. By style returns, we mean the rewards you get from investing with a particular smart style, such as focusing on small companies or on growth companies. And sometimes we refer to those as factors because they're factors that influence returns. and we'll say something about the premiums, the reward you get from exposure to particular factors. And then we have special focus chapters this year, this month. The fresh new feature focuses on corporate bonds and the credit premium. As with all the work that we do, we take a very long-term perspective. So we don't focus on this week or this year or this decade. It's what we can learn by looking at financial history over the long haul. And the sort of things we've written about in the past, we've written about investing in commodities. We've talked about diversifying across different countries. We talked about emerging markets. We've talked about environmental, social, and governance issues. We've looked at private wealth assets. We've looked at the investment performance of housing, of other sorts of factors in returns, hiking cycles in terms of cycles in interest rates. We've looked at industry performance, all of these things in earlier years. And because this is the 25th year that we have produced a book, we've summarized some of the major lessons in a particular chapter in this book. It's chapter 10, and I'll tell you a bit about accessing some of the material later on. And then finally, in addition to looking at particular countries, we look at composite indices. So we now use data that spans a long period for 35 different countries, and we have composite indexes which cover a part of the world. It might be Europe, for example, and there are 5 of those composite indexes. So that's a little bit of a broad menu from which we will draw some themes as I talk with you. And Conrad, feel free to interject if you think that that's needed at any point. Let me tell you about where our data is based. So here's our globe, a flat globe, but there's a color code here. We've got 35 markets on which we have a considerable amount of data. And those markets are shown here, and they consist of 2 groups. One, which we show in red, which we call the Dimson, Marsh, Staunton 23 countries. These are 23 countries where our annual histories all begin back in 1900. And then we have a further 12 with long histories that we relatively recently added into this data set. And these 12 all have at least half a century of past data. But because data wasn't available, typically wasn't available because the country didn't yet exist or didn't yet have a market, there's a dozen, as I say, with long histories, but not with 124 years of data. And then there's 55 other countries where we have data on stock market performance from inception or availability on a database, which means altogether we have a very large number of markets. In light grey, those that are not covered, but there's 90 markets in total for which we do have data, and the 5 composite indexes that I was describing. So let me show you a little bit about performance, first of all. This bar chart shows you what the annualized returns were after adjusting for inflation, after adjusting for purchasing power. And so we're drawing on our database. Mostly there are standard abbreviations here. These are the ISO, three character abbreviations. The one on the extreme right, you'll know, that's the USA, but there are 1 or 2 that might help. Where I might be able to help you. AUT is Austria. Towards the extreme right is AUS, that's Australia. Don't muddle the 2. And then in the middle, we've got WLD, which is the world. And we've got EMG, which is emerging markets. And I'll explain these as we go along. So mostly they're single countries, but sometimes there's a grouping there. So let's look a little bit more. All the equities were red bars Going up, that meant that they all gave a positive return in common currency, the US dollar, over and above inflation. But now what I'm showing you is government bonds. Government bonds mostly gave you a favorable return, a positive return in terms of the real US dollar performance, but not all of them. And so the extreme left, you can see AUT, for example. For all these countries except one, we're looking at 124 years. But for one country, which is Germany, that if you look from left to right is Austria, Italy, Belgium, France, Germany, DEU. That's a case where the government bonds became worthless in the hyperinflation of 1922-3. So in that case, it's based on not the full array, but all but 2 years of our 122 years, because otherwise I couldn't fit that bar for the poor performance in for government bonds. But otherwise, these are all long-term numbers. Treasury bills, a similar story, again with Austria, which had very high inflation, and with 2 years left out of the 124 years for Germany. But you can see that everywhere, or just about everywhere, government bonds, though they had done poorly compared to equities, had beaten treasury bills, or the nearest equivalent of interest-bearing cash in those markets. So there's a quick financial history of investing around the world. And it's interesting to have a look at some particular numbers there. The United States gave us a dollar return of 6.5% real per year. The world, excluding the United States, WXU, gave us 4.3. In other words, the rest of the world lagged behind in common currency, adjusting for the same inflation rates, but was not as favorable. One of our motivations when we started this project 25 years ago was to escape from people extrapolating from the US experience and to think about other countries in the world that may have been less fortunate than the United States. The US is important, as I'll show you a bit later on. So WLD is the abbreviation we use for world. And if we have a market capitalization weighted index that covers not a single country, but all the countries in our database, including even those countries that failed to have a complete history from 1900 onwards, then what you would have ended up with for a world portfolio is 5.1% real. Still a pretty handsome return. Now, if you look at the difference between the equity return and the treasury bill return, you'll see that there was an equity premium relative to treasury bills of 4.7% per year. And if your comparison was with government bonds, the gap is 3.3%. I say without apology, finance professors prefer to think about the equity risk premium compared to treasury bills, and practitioners, at least practitioners amongst you, mostly prefer to talk about the difference between equity returns and bond returns, risk-free bond returns. So there's our two risk premium estimates. Historically, there's been a large equity risk premium of 4.7%. And in our book, we explain why we would expect, looking forward, some of the good luck of the 20th century to let us down and not continue into the future beyond today. So we'd be thinking about an expected return more like 3.5%. Some people ask me, why does it say 3.5 and not 3.5%? That's a sort of indication that we don't really think that we've got so much precision in these numbers that we should be going to 1/10 of a percentage point. So about 3.5%. So there's a little bit in terms of the background of the study. And when we originally did this, we called the book Triumph of the Optimists when Princeton University Press published our work, which is still available. And it was a triumph of those people who back in 1900 were optimistic about investing in risky businesses, risky securities. And they did much better than the cautious people who held government securities, and they did better all around the world. What we didn't realize was that there are a whole series of other questions, and I'll dip into a few of them, where we could confront history with contemporary questions and get some insights by looking at historical data, and that's what we'll do next. So one of the things which we've done is to look at all of the countries and years for which we've got data, and to look at their inflation and the returns that were earned on assets in the same year. So this chart shows you what the boundaries were for the lowest 5% of inflation rates across all 2,600 countries and years. We look at the next 15, the next 15 and so forth, till the highest 15%, and then the remaining 5%. And 5% of these countries and years were years in particular countries where inflation was higher than 18%. And we look at what the performance is of the main categories at those times and in those places. So here in dark grey, what you can see is what happened to bonds when inflation was very low, middling, or very high. So at the extreme left, bonds do extremely well in terms of their real performance, their inflation-adjusted performance, when inflation rates are extremely low. They do very well, 18.9%. And at the extreme right, you can see where inflation was very high, then government bonds suffered in real terms. Inflation eroded the value of government bonds. Now, let's draw a comparison with equities, and you'll see some interesting contrasts. So equities overall did better. If you look at the extreme left, you'll see that equities got left behind when we're at the extreme left of the chart. In other words, when inflation rates and in particular countries were very low. So when inflation is very low, that helps bonds, and it's quite good news for equities that bonds do much better than equities. At the extreme right, you can see when inflation rates are very high, that hurt bonds a lot, but it also hurts equities. And in between, you can see the sorts of conditions which are kind to equities, that is low, not ultra low, but low inflation, middling inflation, where there were country years which typically gave a return on equities of 10 or 11%, considerably higher than was the case for government bonds. So what's going on here? Equities aren't hedging you against inflation, because what you find is that when inflation is high, you lose money on the extreme right-hand bar, or just about break even in purchasing power terms. But they have beaten inflation, and there's a difference between the two. Equities have given you a higher return than government bonds because they have, over the long haul, given you a reward for risk. But that risk is stock market risk, not inflation risk. So what do we do about inflation? And it's interesting to look at different periods in financial market history and to see what happened in attempts to cure inflation. And I'm going to look with you at the United States and later at the United Kingdom as my two primary examples. So what we've done in our book is we've looked at data on inflation and what's being done in terms of interest rates set by the US Fed. And then we'll look at something similar for the UK. The US Fed was determining what interest rates will be from 1940 and onwards, and we've got a daily record of interest rates. And what we've asked ourselves is, how do stock markets perform if the Fed rate falls, which we plot in red, or after a rise in the Fed rate. And so the first bar that I'm showing you is the purchasing power adjusted return on equities. And when you invested at any period after a rate fall, that was much kinder subsequently to the stock market than after there's been a rate rise. What about bonds? Well, bonds did not do as well as equities. That's consistent with what I showed you earlier. After a rate fall, bonds subsequently went up, but only by a few percentage points. And after a rate rise, they did not go up at all. What about treasury bills or cash? There's very little difference there. And what about inflation? Well, after a rate rise, what you found was inflation was higher. It is not the case that a rise in the Fed rate causes inflation to be high. The rise in the Fed rate is there to control inflation, and inflation is sticky. When inflation rates are high, it takes a while until they come under control. So we find that inflation, the grey bar, is higher after a rate rise than after a rate fall. What does the picture look like for the UK? It's very similar. If you buy after a rate fall, equities do well. And if you buy after a rate rise, they more or less stand still. Same is true for bonds, but bonds don't give you as high a return as equities. You'll recall that the equity risk premium is the difference between equity returns and bond returns. And you can see for both the US and the UK, let me focus with you at the UK, what the difference was between the two. The difference between equity returns and bond returns after a rate fall was substantial. After a rate rise, there was nothing going on there at all. The impact is that the equity risk premium was mostly something which was earned during easing cycles and not during tightening cycles. So the interest rate environment has had an important impact on the performance of equities compared to bonds or bills. Let me now think about one or two other questions that people are talking about. One of the things which we see in the press as an important factor is the performance of the Magnificent Seven, the large US companies, and they've driven the US to large values. We also see something in terms of how people allocate their assets and the concern about whether they've got a suitable international spread of assets. Our data begins in 1900, and on the bottom left-hand corner, you can see the United States represented 15% of the global equity market back in 1900, which is sizable, but not as big as Great Britain, and not very different from Germany or France. As we go through from left to right, you can see several things change. One is that on the left, you can see Russia, and you can see above it Austria. Russia disappears, Austria becomes extremely small. There would be China, but it's so small back in 1900 that it doesn't really show up on this chart. Move your eyes over to the extreme right, and you can see the United States, in terms of its share of world equities, quadrupled, moving from 15 to over 60%. You can see Britain, which had represented a quarter of the world's equity market, has shrank in its proportion. And you can see that the runners-up, countries like Japan, are modest. You can see China, which had not become small, but had disappeared during the communist period, has grown. It's now 3%, it's a sizable market. Whereas on the left, we're just looking at market capitalization for companies. On the right, we look at free floats because those numbers are available now and because cross-holdings are more important to think about than they were arguably in 1900. So China there is free float. If we were looking at total market cap, China would be bigger still. And so you can see that along with, in black, a set of other countries, which are just in aggregate worthwhile, but individually are too small to plot here on the chart. So the UK was the largest. Briefly, as we went through time, while we saw the US getting bigger, it shrank to being the second biggest, about 3/4 of the way across this chart, where briefly Japan became the largest equity market in the world, but that didn't last, and the US is the biggie today. The other aspect of concentration that we sometimes talk about is how these big stocks, I mentioned the Magnificent Seven in the United States, and people worry about whether markets are being driven by a small number of stocks, and that market is too concentrated. We've looked not only at whether the world market is concentrated by particular countries, but also within countries. And so in the United States, it turns out that if you look at the largest stock, that's only 6% of the market, and the 10 largest stocks represent 29% of the market by value. That is not all that big. If you have a look here at the other countries for which we've got data, you'll see the United States is one of the least concentrated markets. That is, the 10 largest stocks in the US represent 29% of the stock market. For Japan, there's even less concentration, but for many countries, including some which are quite sizable, it can be a majority of the market that is represented by the largest 10 companies that have a listing. So the US is one of the world's least concentrated markets. Japan is less concentrated, but others are mostly more concentrated. Another question that we can think about, what are we going through now in terms of setbacks that we have? And setbacks to the market, it's interesting to have a look at what has happened when there's been a severe drawdown. The drawdown is a loss in value relative to a high at some date in the past. And here you can see what happened during the Wall Street crash. During the Wall Street crash, there was a 79% real terms decline in the value of the market. We're looking here at the return from high, and then we have a rather unusual time axis. We're looking day by day for the first 50 days, then the next 100 weeks, and then monthly data. And we're doing that to see the dip and the recovery for this and for some other bear markets over varying timescales. It took over 15 years for the stock market to recover to its pre-Wall Street crash high. What about other crashes? The next one I'm showing you is the mid-70s oil shock. And that meant that stocks fell in real terms by 56%. They were halved. But it took all of 10 years for the stock market to recover. The dot-com bust at the end of the dot-com era, the very end of the 1990s and the beginning of the 2000s, very, very beginning, you can see there was a 49% negative return in real terms, and it took 7.5 years to get back to where that market had been before the collapse. And the global financial crisis, that was a 56% real return loss, a loss in purchasing power after taking account of the total returns of the market. And it was over 5 years until the market had returned to its previous high. What about the recent pandemic crash? That was really rather striking by how brief it was. There was a 35% fall in value to the bottom of that bear market, but only half a year to have a full recovery back to what the value had been in real terms before. And so the question that was being asked is, what about the market conditions that we're going through now? And we haven't seen a recovery yet. So this last line is the 2021 collapse, and the market has nearly recovered to where it was. So we know it's going to be at least 2.3 years, but we don't know quite how long it'll be until the market has recovered. So it is the case that the recovery periods are getting quicker. There's not very many observations that we've got here. We've had 2 of these events this century, and we've got 3 from the previous century. So are bear markets getting more frequent? We don't really know, but they can be pretty severe. Our recovery is getting faster. Well, they were fast in this recent period, this century, but we don't really know. So we should expect that there will be these protracted drawdowns, but whether those will be really temporary, like the last 2, or whether they could go on for much longer periods, that is less clear. So we've got to expect those drawdowns. If there wasn't the chance of a severe drawdown which lasts for a long period, then there wouldn't be any need for an equity risk premium. If equity risk consisted of markets going up, moving sideways, and just occasionally collapsing and then having a recovery, that would not cause people to price in a reward for risk that we believe that they do price in all markets.
Elroy, we actually have some questions now. And
let me
Nicholas,
pause for questions.
yes, Nicholas.
I thought I might have provoked a question. So yes.
So Nicholas asks, actually, going back to the last few slides, are you arguing that the equity risk premium is driven more by changes in the risk-free interest rate rather than changes in market returns?
What I said was that the equity risk premium represents a reward for equity risk, not a reward for inflation risk. So equities viewed as a hedge against changes in inflation are unreliable. When inflation rates are large, there is no guarantee that purchasing power will be maintained by the stock market. And those of us who are old enough to have lived through it, like the high inflation rates of the 1970s in Britain, when year-on-year inflation exceeded 25%, we now know that was transitory and inflation was destined to go down from 25 to 10 to 5. But at the time, we did not know whether it was going to be higher still, and equities really suffered a great deal. They have given a reward, but we believe that that reward is a reflection of the volatility of the stock market. In terms of interest rate conditions, we believe that the return that you can expect from the stock market is a reward over and above risk-free rates. And so if you're in a period where the Fed determines rates that are low, equities will tend to give you a lower return. It might have looked as though there's an arbitrage opportunity there, but these are all conditions which happen at different times. So you can't mix and match opportunities that happened in different decades.
And since you're talking about the Fed, Ashish asks, there seems to be a state of exuberance in US equities, but interest rates haven't fallen. So what's going on? Is this rational or irrational?
Ashish must be a young man, because interest rates did fall and they kept falling a long time. They moved up a little. So one of the questions that you could equally well ask is, what are normal interest rates? And we have not moved back to the way things would be if you average them over a very long period. To be sure, interest rates have gone up over the last year or two, but it's difficult to push me into giving short-term predictions. I prefer to give predictions where you can come back to me in 100 years' time and tell me whether I got things, in your opinion, right or wrong. So, yeah, interest rates have gone up lately, sure.
Well, Roger asks you, how much has your analysis changed over the last year since your last report?
Well, Roger will be my favorite person so far, because that's something I'll talk about in a few minutes' time, where I've got some charts to share with him. So, Roger, be patient.
All right.
And you might come back with another question. So let me show you a little bit more in terms of the drawdowns. So people talk about equities and bonds and what the risks are. This is a drawdown chart. So for those of you who are not in the investment world, particularly if you've never had exposure to the pitch that you'd get from a hedge fund, a drawdown chart is a chart showing what cumulative performance was from a previous high. And so you can see here that there are periods of underperformance, and then there's recovery. And you can see around about the 1930 point on this chart, you can see the almost 80% loss in real value for investing in US equities, and a near recovery, but not quite full recovery, a bit later. Then you had to wait more years to actually see a full recovery. So equities have these setbacks, and there have been occasions, you can see it in the 1970s, more or less around the turn of the century, and then more recently, a decade into the current century. You can see cases where equities in the US had lost, compared to a previous peak, 1/2 of their real value. Now you can compare that with government bonds. And the striking thing is that government bonds that had similar experiences on the left of this chart, you can see on the right, there were similar sorts of experiences in terms of loss in value from the bond market, and a very long period of being underwater. So underwater is when you see a decline and you haven't seen the asset increase in value back to the zero line. So bonds had a very long period where, in real terms, you were still suffering, and bonds therefore are not safe. They've also had large drawdowns, and that motivated us a year ago, not in the current yearbook that I'm describing, but the one for 2023, which I will mention again later on, for us to look at commodities as an inflation hedge. If you're concerned about this, we draw some comparisons between the extent to which commodity futures might leave you underwater compared to bonds and equities. So what are the most dramatic declines? And here you can see the longest periods of negative real returns. You can see in the US, we've had equity returns which have gone down for been underwater for as long as 16 years. Historically, if you'd had a holding period of 17 years or more, you would never have ended up with a negative real return. And there are some countries that are in a similar position, but there's other countries where real returns were negative for periods of 40, 50, 60, 70, 100 years. But that's even worse if you invest in bonds. Bonds give you sometimes very large exposure to those market conditions. So if you invest globally, and if you invest across assets, you get some benefits of diversification. So these are the extreme cases for single asset investors investing in a single country. We also look at factor premiums and whether they go negative. We look at the low volatility premium, for which we have 40 years of data in total in 13 successive years up to 2021. low vol would have done worse than investing in high volatility stocks. And we can look at others for across the UK and the US. The most widely cited factor is value, and you can see at the bottom, we have 69 years of data for value investing in the UK, 97 years for the United States. And you can see that there have been periods running up to the very recent past in which more than 30 successive years were ones in which factor premiums failed to recover to where they had been at the beginning of a period of setback. So factor effects will continue, but will they be premiums? We're more cautious than we were. And the final thing...
Actually, Elroy, sorry.
Yeah.
I think on the part about factor investing, Roger's question, I mean, Roger seems to have read your book, because he says you covered factor investing, things like size, value, income, momentum,
yes,
volatility.
Indeed.
Yeah. So he asked whether quality could be another factor. So in terms of return on equity, operating margin.
The easy one, quality is potentially a factor. We don't have the arm's length data for enough countries to present the same story on quality, for sure.
Okay.
Let me show you a bit about economic growth, which often interests people. There's a belief that stock market performance will be better if you invest in high growth countries. The extreme example of this is China. You can see here on the left-hand side of the screen what per capita GDP has been in real terms. Wonderful in China. Compare that to the United States. And you can look at the inflation-adjusted performance of equities, and you can see the US has won compared to China. And we've looked at this in many different ways over time and across countries. There's a negative correlation between per capita GDP growth and stock market returns. And we talk about this in the book, about some of the explanations for this. I want to answer that question that we had earlier about what you might expect for the future. So my generation are kind of the baby boomers. And so for equities, the real return that baby boomers had was a remarkable 6-point-something% on equities, and on bonds 3%, and on a blend 5.6%. Generation X, that's the world since 1970, 5.45, so about 5% as the return on equities or on a blended portfolio. Millennials, people who are focusing on the period since 1990, it was a similar story. And so the question that people ask is, what does the world look like looking forward? Looking forward, let's start with bonds. That's the dark grey area. Our estimates, just based on the redemption yields on inflation-linked bonds and on conventional bonds and inflation expectations, is that you would expect to get about 2% real from government bonds. And our equity figure of 4.5 is simply, sorry, let me just rephrase that with a slip of the tongue. You'd expect to receive 3.5, sorry, 2.0 from bonds and 4.5 from equities. And what we're doing is we're adding an equity premium to fixed interest returns to estimate what we would expect from equities. And then on the right-hand side, you can see the 60-40 blend. So Generation Z might expect something of the order of 3.5 for a 60-40 blend of equities and bonds. What were we talking about 2 years ago? Roughly 1.5, not 3.5%. So our projections, which are based on market interest rates and the historical equity premium, have recovered to some extent. The world doesn't look quite as good. We've exited the low equity and low bond return world. But past generations were lucky. Looking forward, you need to save more for the future than we thought was necessary when we were in the early stages of this research. I'm just going to mention where our special feature article can be found. We write on corporate bonds and the credit premium. I'm going to just slip past some pictures because I want to tell you how you get hold of more of this information. We look at yield spreads from the 1860s onwards. We look at default rates, again, from the 1860s onwards, and provide a quite detailed analysis looking at British as well as American data. But some of the things that have caught people's attention, the current issue of The Economist was captivated by our views of risk. Wall Street Journal focused on fear of missing out and looked at equities compared to bonds and compared to bills. That's what I was showing you earlier. This was the Financial Times a very few days ago on factor investing. There's been a lot of commentary that has captured people's attention, and so I hope you'll have a chance to have a look at things for yourself. So financial history, we think, can inform future strategy. Winston Churchill's famous quote, the longer you can look back, the further you can see forward. We write a special chapter, and we'll be pleased if you will read that on corporate bonds and the credit premium. You can get that in the summary edition of this book. For that, you would go to www.tinyurl.com/GIRY, Global Investment Returns Yearbook 24. We've got a few old editions of the hard copy yearbook, which was sent over to you, Conrad. And those people, particularly those who are in the university or around the city of Cambridge, are welcome to meet with you or arrange with you to use up the copies. There aren't a huge lot of them, but you can buy the current one. The money doesn't come to me, I'm afraid. But, there are some of them very recent, which I hope will be of interest. So that really covers what I wanted to talk about, Conrad.
Yeah, well, thank you so much, Elroy. And for the viewers who want to get the summary, the URL is there. The QR code at the corner will also get you to the summary edition. So, Elroy, I just had one question, and that is, in your book, you quoted the late Charlie Munger, right? There's no better teacher than history in determining the future. There are answers worth billions of dollars in a $30 history book. Why do you think that's the case when the financial markets seem so different and more sophisticated now than 40, 50 years ago?
Well, apart from the fact that I'm not sure where he gets his low-cost history books from, I think what Charlie Munger was talking about is the fact that you really can't say anything about the future or even the present without having an anchor for comparison. If you were to be asking yourself, should I be investing in equities for the long term, or should I be keeping my money in cash? The lessons of history are helpful. That's not to say you shouldn't be thinking about the future, you absolutely should. But Munger is reiterating the fact, and of course he's not a young man, but he's reiterating the fact that understanding where we've come from is helpful in terms of thinking about the road ahead. That's maybe what was in the mind of UBS. They chose the pictures that intermittently get scattered into this book. So this is perhaps the long road ahead, but I'm not sure.
Well, thank you so much, Elroy, for giving us that historical context to global investment returns. And if you like the show, please repost it on your social network. The balance sheet will take a mid-season break. We'll return on 19th of April with an episode on pricing power. So till then, stay well, stay safe, and we'll see you next time.